In fact, two such guests join us on the show right now. Manish Sonthalia, who's of course the CIO at MK Investment Managers, and Pradeep Bhattacharya, who's joining us from Edelweiss as well. Thank you, gentlemen, for making time and speaking with us. Good afternoon. Let me start by asking you, Manish, first. What's the base case scenario that the market is building in right now? And do you think there could be a potential surprise, let's say, if the NDA does come back to power with a majority which is more than 320, 330 seats? Is there a possibility that there could be further uptick in the markets?
So I think base case for the markets, which they are building in right now is close to around 300 seats for the BJP and around 330, 340 for the NDA as a whole. And if markets will clearly get surprised on the positive side if the numbers are closer to 400, and the chances of that are very slim. And in case the BJP gets less than 280, it would be a negative surprise. So all in all, if the numbers for NDA are between 320 and 330, markets would be neutral. I think it would be plus minus 1% on the counting day. And thereafter, I think after a couple more days, 3 or 4 more days, you will see, the markets taking shape on the positive side. But that's how I think the poll results are building up.
Right, Pradeep, good afternoon. This is Vinny joining in the conversation also. And what's your thought on it as well? Similar to what Manish is expecting, what are you all penciling in?
Overall, my sense of the read of the expectations, of course, we are dealing with short term, and in the context of markets, this is just a blip. With that disclaimer, I would say that a range of BJP plus allies between 300 to 350 would be broadly neutral zone for markets. BJP and allies 350 plus would be a bit of a short-term rally zone for markets. And BJP plus allies less than 300 would be a negative surprise for markets from a very short-term perspective.
Point taken. This is, of course, a short-term phenomenon, not something that changes the fundamentals of the market. But Pradeep, with that scenario in mind, what's your own expectation? Have we made a top for the year? Because we're already above 23,000. The best of the earnings cycle, as for some people, is already behind, and Q4 being the best of it. What's your own expectation? Where should we end the year?
I think let's kind of, for a minute, get away from this and look at a couple of data points which is true irrespective of elections. First of all, if you look at the capacity utilization of India Inc. as a factory, we are operating at awfully close to 80%, which usually, in most times than other, signify a start of a capex cycle. Second, if you look at the real estate sector, we are looking at housing unsold inventory at close to 12-year lows. Third, no matter which way you cut it, over the next 12 to 18 months, the direction of rates is likely to be down rather than up, which is generally seen to be pro-companies, pro-animal spirits and whatnot. The ordering that has already been done for defense is good enough for order book for companies for the next 5 years. So if you look at these data points don't change irrespective of who comes in the power. So from a fundamental earnings growth standpoint, and markets over a period of time ultimately are a slave of earnings, I would say that India and India Inc. is in a state of earnings resilience, and it has become broad-based over the last 2 or 3 years, and I expect that over the next 2 to 3 years as well, this broad-based nature would actually continue. Whether we will get a support from global or macro backdrop or not is a matter of debate, and if it does, when it does, we will see how much it aids the growth. But net-net, broadly speaking, I would suspect that earnings for India Inc. are likely to be robust. And then within that, it's likely to be stock picking, which is going to do the talking for all of us as fund managers.
Absolutely. But Manish, I'm going to come to you and pick out a point. So far, we've not seen those FIIs participate. And despite that, we've seen the market run up. Nifty is touching new high, Sensex at new high. What will be that mover in terms of, will the election results actually be a mover in terms of the FII flows coming back?
Looks most likely that way. The India allocation in MSCI, ex Japan has only reasons to go up. And we are looking at a record short position on the derivative side. I mean, this is what I'm given to understand from the FI front. So if the numbers are no negative surprise on the poll results, then obviously those shorts have to be cut and then longs have to be made. On top of that, mutual funds are sitting on 10% of cash, which is roughly more than 2 lakh crores. If you assume that 20 lakh crores plus is the size of AUM in the equity segment in the mutual funds. Plus, you have the retail participation because now you have visibility for the next 5 years in terms of stable government and policy continuity and all of that. Plus, your earnings growth trajectory on the next 2 years is going to be at worst uh, a mid-teen sort of a earnings growth. At best, it could be closer to 19-20% also. And valuations are not very expensive if you look at even from an FY25 perspective, more so on FY26 perspective. All in all, if the poll results do indicate a continuity of the government and whole lot of reforms expectation, then obviously the levels on the market could be seen as very conducive for investments from a medium term perspective, and FIs being long term investors look at it that way and should in all probability participate in the journey of India's growth.
Just coming back to the point, what Trideep was also making, Manish, and that was about stock picking, right? Now, there are two, sets of theories right now, Manish. One end believes that whatever has worked so far will continue. So, your public sector, defense, industrials, PSUs, they are expected to rally well. The other believes that the ones which haven't worked out well, which is your BFSI, which is your FMCG from the point of view of rural recovery, that's going to do better. So there's expected to be a bit of a churn there. Which end do you think will behave better in terms of the alpha generation, continuing with the momentum or buying the undervalued?
So I think at all points in time, as managers, fund managers, we look for margin of safety, and you could find margin of safety in BFSI, given that earnings growth has been pretty strong. You could find margin of safety even in the technology pack if earnings recovery were to come in the second half of this year. But there could be a significant margin of safety in public sector units, given the growth trajectory on many of these monopolistic sectors like power, logistics, oil marketing companies, commodities. You could see distinct value being, trading at single-digit P multiples or 3, 4, 5% dividend yield. I mean, my sense is that there's a mountain of money waiting to get invested in markets. How long can we ignore the PSU just because it belongs to the government and things are only becoming better out there?
Right, and Deep, what's your thought on it? Where do you see the move coming in? Would you like something like infra, defense, and industrials, or is there something else that in terms of sectors you would look at?
If I link it to the overall medium-term growth journey of India Inc., then we are at a stage where I think infrastructure creation would be an important part of the incremental GDP growth that we will see. And for that to happen, hence, directionally speaking, infrastructure part of the economy would probably grow faster than what it has done in the past. But what we do have to do is to calibrate this against where the resident valuations are. And hence, I keep on highlighting that stock picking is of utmost importance, even within infrastructure or the sectors where we are likely to see leadership. But your question is, the sector leadership, in my opinion, will continue to be capital goods, infrastructure, defense, and those kind of names, as opposed to the other parts. The other parts, of course, we would do cherry picking with regards to where valuations are favorable, and if there is a turn of fundamentals, whether it is IT, whether it is FMCG, and whatnot. But directionally speaking, over the next 4 or 5 years, the sector leadership is likely to be infra, capital goods, and whatnot, capital goods and construction, as long as there is policy continuity on the top, which is what's the basis assumption in all of this. The risk to all of this is basically, if any sort of knee-jerk reforms were to be attempted, then I think the market we'll have to calibrate that and act accordingly. But directionally, that's the market setup right now.
Does that risk factor a bit more. Manish, what's your thought regarding what Pradeep is saying, that the risk factor is lack of continuity and some knee-jerk policy action? Do you think that is possible, that in case NDA gets a, let's say, lower seat than was envisaged, let's say somewhere between 270 to 320, they might look at more social spending and curtail the capex spend? Is that a possibility that you envisage at all, or any change in their overall mindset, maybe tax rationalization, etc.?
So, I think our finance minister and even our honorable prime minister has given you a brief of how the things are going to look like within the first 100 days of the formation of a new government. What all works are there in the pipeline. The finance minister has also alluded to the fact that there is not going to be too many tax changes when it comes to capital gains tax. There were some apprehensions that capital gains would go up and all of that. So I would believe that as long as the numbers are 272 plus, there will be some sort of a policy continuity and within the corporate sector, and ease of doing business. That momentum will not be taken away, and build on that. I think major reforms, etc., would also be attempted, but and this would include your uniform civil code, your the tougher part being labor reforms, the judicial reforms, the farm sector reforms. That would be much easier if the numbers were closer to overwhelming majority. But if the numbers were not that great, even then, I think the growth momentum for the new government should be on the positive side. Of course, the pace at which it gets implemented needs to be seen. But I think all in all, markets would want to see policy continuity. And FIIs will get particularly very excited on the positive side when it comes to major policy reforms. So, when it comes to labor reforms, you say that India is now preparing itself for some tough reforms again, or let's say judicial reforms or a uniform civil code. So, I would look at major reforms as major positives for the Indian market, notwithstanding the fact that there could be some impact on the economy, as was in the case of demonetization, GST implementation, RERA, ITC. They were tough reforms. The economy got a shock, but we are seeing the positive effects of all of that now. So any major reforms will need to see some, hit and resilience from an economy point of view. But I think that's how reforms happen.
So there might be some reforms which are needed, but more or less the street is penciling in continuity in policies. But Pradeep, to the point that you are making, that for the next 4 to 5 years, defense, industrials, infrastructure, that's the theme to be in. But if I had to, zoom it out a bit and ask you about the entire market setup for the next 4 to 5 years, what to your mind is the realistic expectation from the Indian markets in local currency terms, of course, for the next 4 to 5 years? Is it going to be the usual average of 10 to 13%, or there's a possibility that the returns from Nifty over the next 5 years could actually be better than the historic long-term average?
So I think if you look at, as I keep on saying, that markets are a slave of earnings. Over the last 25 years, earnings of India Inc. has compounded at a rate of 17%. Now, depending on when the investor gets on and when you take the starting point, broadly speaking, an expectation of 10 to 15%, purely based on how historical numbers have come through, is not a bad place to anchor expectations, as long as it's over a period of 5 years or longer. And I think that trajectory is unlikely to get disturbed by these elections or anything that I see or read in the near term. If anything, if there are certain sectors which historically have not been represented in the listed part of the economy, becomes a prominent part. For instance, if you look at it, still capital goods, infrastructure and construction forms anywhere between 10 to 15% of the broader market indices, or probably lesser, and that is after a couple of years of good rally. If they were to become a meaningful part, then the whole market expands, like we have seen over the last decade or so. The banking part expand in a meaningful way, And that would mean broader investment choices for fund managers, broader investment choices for FIIs, and hence a good news for practically everyone. But basically, what I'm talking about is an expansion of the listed space market cap over the next 5 years, and broadly compounding anywhere between 10 to 15% should be a good point to anchor around as long as the outlook is 5 years plus.
Manish, I just want to know, in terms of incrementally, where do you find more safety in terms of investment, or where would you look to invest in? Would it be more on the mid and small cap side, or would you still look at the large cap?
No, I think, in terms of benchmark indices valuations, 22 and a half times current, or maybe 21 and a half times current year numbers don't look very sovereignly expensive. From a large cap point of view, I think it's very frivolous to actually generalize the broader markets in the mid cap and small cap space on a broad brush basis, because it's all about individual stocks in the mid and small cap space. So I think one should go with a blend of both large caps and mid and small caps, create a portfolio roughly having a weightage of 40, 45, 50% in large caps and unique names in the broader markets to the extent of 40, 45%. I don't think a full mid and small cap portfolio would do justice in terms of risk and reward, and neither would a full large cap portfolio do justice in terms of risk and reward. So all in all, a multi-cap, flexi-cap approach from the next 3 to 5 year point of view is optimized for risk and return. And I think in terms of margin of safety, there is one sector which, to my mind, in the next 3 to 5 years is going to likely get re-rated massively, is the public sector unit at large. Because, given the growth, given the monopolistic nature of many of these businesses, it's just ridiculous at the valuations and the difference in valuations in many of the same businesses between the PSU and the private space. That will get narrowed.
Interesting. You still see a lot of scope of, uptick on the PSU side. They've run up quite a bit in the last 12 to 18 months, but clearly the differential is still quite high. Trudeep, before I let you go, leave me with a big, the theme that you're watching out for, let's say, for the next 4 to 5 years, apart from the defense industrials that you already talked about. Where do you see the margin of safety the maximum?
So I would point to power and railways as two areas where I think over the next 2 to 3 years, a lot of spend will go, a lot of earnings, companies exposed to these two segments will benefit meaningfully over time, and we haven't seen ordering to the effect that I'm talking about over the next 3 years going forward. And one area which I think is probably biting dust right now and could meaningfully re-rate over a period of time, and period of time is 3 years, is I would point to chemicals as a space where I think it's a niche sector where it has gone through a meaningful amount of de-rating over the last 3 years. I think as the global destocking were to sort of ease, you could see some of these stocks kind of do well over a period of time. But barring that, if you look at where 70 to 80% of our portfolio are, it is focused on manufacturing, underweight consumption, overweight domestic earnings, and neutral, I would say, overseas earnings.
Question to you, Manish, before we let you go. Which are the areas you'll recommend booking profits ahead of elections now that you think they've already run up? Anything which you would want to trim?
So there is obviously the long-term theme in terms of capital goods, industrials do look bright, but some of these names in the private sector, power equipment, etc., have gone through the roof, and some of these names don't justify valuations according to me. Even though, or some of these power cable companies, I understand there's reform in the power sector, but how can you have, but the momentum is just too strong. But, some of these names on an individual sector-wide, even in the industrial space, do seem to be out of whack when it comes to valuation on a short term to even, 1 year, 1.5 year earnings point of view. Some of these names could be candidates for booking profits. I don't think there is a case of moving out of any other space. In fact, some of these banking names or some of these IT names could be good candidates to bottom fish because the earnings growth, at least as far as the BFSI space, is just continuing to hold. And in the second half of the year, the IT space could also look good. But and PSUs, as I alluded to. So on the buy side, there could be some dark horses in terms of commodities, which could do very well this year. Metals specifically, the public sector units, the BFSI, and within BFSI, the banks, and your IT. On the negative side, I would believe some of individual names in the capital goods space seems to be just riding the momentum and flow, bereft of fundamentals, at least from a short-term point of view. These could be your power and cable, these could be your power equipment suppliers, etc. It doesn't matter if you are a long-term investor for the next 5 to 10 year point of view, because growth will take care of these valuations. But I mean, everything seems to be priced into perfection or more than perfection when it comes to the extreme short term or even the short term.
Fair enough, that explains it. So be a bit more selective when it comes to capital goods, etc. But there's a long road of value available in dark horses. Could be the likes of BFSI as well as IT. Thanks, Manish, as well as Pradeep, for making time and speaking with us. So that's the CIO poll that we conducted at ET Now, and those were the top recommendations as how you should wade through the volatility as well.
If you like this video, then like, share and subscribe to ET Now.